Hi, and welcome to the first part of Problem 1-8b, which is on page 42 of your textbook. Before you start, you should open up and print the template that is provided so that you can follow along by making the entries by hand on your piece of paper that you print. Problem 1-8b is where we are analyzing transactions that have happened in a business, and then we are going to use those transactions to prepare our financial statements. We are also going to look at how each transaction is affecting whether it is an asset account, which is cash, accounts receivable, equipment, or is it affecting a liability account, and a liability is something that we owe but have not paid or provided a service or product for, or did it affect a owner's equity account, whether it be the capital showing the owner's claims to the assets, any withdrawals, which is the owner withdrawing assets of some kind from the business, is it a revenue or is it an expense of the business? The very first part of the requirement says to arrange the following: assets, liabilities, equity titles in a table like Exhibit 1.9. Well, that's what we have already done right here. We have it prepared. So we're getting ready to do part 2 of problem 1-8b, which says that we need to show the effects of the transactions on the accounts of the accounting equation by recording increases and decreases in the appropriate columns. It says do not determine new account balances after each transaction, but we will determine the final total for each account and verify that the equation is in balance when we have completed all of the transactions. So let's get started. On June 1, it says that K. Stone invested $120,000 cash in the company. Because of the business entity concept, which says that we do have to keep our actual personal records or the owner's records separate from the business's records, we're going to be looking at this from the actual business side. So our cash in the business is increasing by $120,000. But we also know that every transaction, if you read the chapter, which you should have, that there has to be at least 2 accounts that are going to be affected by these transactions, and that our assets have to always equal liabilities plus owner's equity. What happened here is that the equity, or in this case the capital of the company, increased by the $120,000 investment that the owner made. And so this was an investment by the owner. On June 2nd, it says the company rented a furnished office and paid $4,500 cash for June's rent. So we know that cash is going to be decreased by the $4,500. And notice that when I put this in here, although I started with a minus sign, Excel is in accounting mode, so it automatically did what you are supposed to do with accounting, is to put parentheses around a number which denotes a negative amount. So we know cash has decreased by $4,500. So what other account was being affected here? Well, in this case, it was the expense account. And since expense accounts reduce equity, then we would put this in as a negative $4,500 here, because this will reduce equity by that amount. And of course, what type of an expense was this? It was a rent expense. Now, what I'm doing here is I'm keeping track of what each of these transactions are, so that when it comes time and I'm going to prepare my income statement and my balance sheet and my statement of owner's equity and my statement of cash flows, I will actually be able to just look here instead of going back to the textbook to find what these transactions were about. Well, what happened on the 4th? It says that the company purchased $2,400 of equipment on credit. So if we purchased equipment, that means the balance in our equipment account is going to increase by the $2,400. But we didn't pay for the equipment at that time. When we say we purchased something on credit, it means that we received the item, but we will pay for it at a later date. And if we have that, that is a liability, which in this case we will use the accounts payable. It is also increasing by the $2,400. So we had a purchase for our equipment. On June 6th, the company paid $1,125 cash for this month's advertising of the opening of the business. Again, we are going to be reducing our cash account, and at this time it's $1,125. And we know if we're advertising, that is probably an expense also. So over here, we are going to put in a negative $1,125. And what type of an expense was this? It was a advertising expense. On June 8th, the company completed maintenance services for a customer and immediately collected $750 in cash. So we have created a revenue for our business. Our cash is increasing because it does say we collected it immediately. And since we had provided that service, that is a revenue that we are going to record, so it increases by $750. Now we can go ahead and put that this was a revenue over here, but we also know that it was a revenue here. On the 14th of June, the company completed $6,300 of maintenance services for City Center on credit. So now this time, instead of us purchasing, like we did here with the equipment on credit where we owe somebody, what we have done now is we have completed and earned a revenue, but the customer hasn't paid us yet. So we would put that in our accounts receivable account, and the amount was $6,300. But even though the customer has not paid us, we are using an accrual accounting system, which means we're going to record the revenue even though the customer hasn't paid us yet. On June 16th, the company paid $900 cash for an assistant's salary for the first half of the month. Well, if we paid our assistant, then we do know that cash is going to be reduced by the $900 of which we paid them. Also, since this has to do with the operation of the business itself, we know that that is an expense of the business when we pay our employees. And of course, in this case, it is a salary expense this time. On June 20th, it says the company received $6,300 cash payment for services completed for City Center on June 14th. So what they're telling us is that our customer here, who we provided the service for on credit originally, is now paying us. Well, we know that cash will increase by the $6,300 that they paid us, but we also know that accounts receivable will decrease by the $6,300. Now, if we were posting this to a ledger account, we definitely want to make sure that we show this, because if we don't reduce the customer's accounts receivable account, we're liable to send them a bill for this amount, and it may not make them happy, especially since they've already paid us. Now, notice this just affected these two asset accounts. One was decreased by the $6,300, one was increased by the $6,300. A customer paying us something that was owed to us, notice that had nothing to do with revenues, and so it will not be recorded over there. We just show that we recorded that the customer paid us for something that was owed to us. So we had a payment from customer. On June 21st, the company completed $3,500 of maintenance services for Skyway Company on credit. Well, this is similar to what we did up here. So we are going to increase the accounts receivable by $3,500 because the customer we provided services for is going to pay us in the future. That did increase our revenues by that $3,500 at that time because we did provide the service. Later on, when we receive payment, we will just show the increase in cash and the decrease in the accounts receivable. On June 24th, the company completed $825 of maintenance services for Comfort Motel on credit. Again, this is the same as June 21st. It's just a different customer. And so we're going to increase accounts receivable by the $825. but we are also going to increase our revenue account by the $825 also. On June 25th, the company received $3,500 cash payment from Skyway Company for the work completed on June 21st. So what the customer is doing is they are paying us the money that is owed to us. And this is another one of those where your cash is going to increase by the amount of the payment, and your accounts receivable is going to decrease by the amount of the payment. There's no other effect over here because we're still in balance. We just had our payment from our customer. On June 26th, it says the company made payment of $2,400 cash for equipment purchased on June 4th. So this time, instead of someone owing us, we go back up here to this equipment that we purchased on account. We're now paying off our bill to a vendor whom let us buy that equipment on credit. So cash will decrease by $2,400, but our liabilities will also decrease by the $2,400, so that it will show when we post this to a proper account that we do not owe our creditor anymore because we have paid them. On June 28th, the company paid $900 cash for an assistant's salary for the second half of the month. So what we've done here is we are paying our employee again, which would reduce our cash by the $900 of the payment, and it will also increase the negative amount that is in the expense account by that $900. And this, of course, was a salary expense for the company. On the 29th of June, K. Stone withdrew $2,000 cash from the company for personal use. Anytime an owner withdraws money from a business for personal use, that is not an expense of the business. It will only show up as a withdrawal. The same as when the owner invests more cash in the business, otherwise what happened here on June 1, that is not a revenue of the company, it is just an increase of the capital. So we are going to reduce our cash by the $2,000 that the owner withdrew, and we will put that in the withdrawal column on that date. And because withdrawals reduce equity, just like expenses, we will record that as a negative. You will also hear me refer to a withdrawal as a drawing. Just know that a withdrawal and a drawing are both the same thing. On June 30th, the first June 30th listed here, it says the company paid $120 cash for this month's telephone bill. Again, we have paid the bill, so we're going to reduce our cash by the $120. And since this has to do with the normal operation of the business, we are going to put a negative $120 in our expenses, otherwise our expenses are increasing. And this is a telephone expense that we have recorded here. It also says that on June 30th, the company paid $525 cash for this month's utilities. We have paid it, so we are reducing our cash by $525. We are also, because paying our utilities is a normal operating expense of the business, a negative $525 in expenses. Of course, what type of expense is this? It is a utilities expense. Well, now that we have completed all of the transactions and analyzed each of them, put them into the proper columns, what we're going to do is we are going to total all of these transactions for all of these accounts, and then we're hopefully going to look at it and know that our assets still equal our liabilities plus our owner's equity. If they do not still equal, we'll probably have to go back and figure out what type of a mistake did we make. So let me sum up each of these columns. Okay, we've summed up each of the columns, otherwise added everything together, negatives to positives, all that fun stuff. Our cash has a balance of $118,080. Accounts receivable still has a balance of $825. Equipment has a balance of $2,400. Accounts payable has a balance of $0. Capital has a balance of $120,000. The withdrawal account has a negative $2,000 balance. Our revenues has a balance of $11,375, and our expenses have a balance of $8,070 negative. So maybe we need to check to see if our accounting equation is still in balance. And remember, these three accounts here are assets, and of course our assets totaled up must equal liabilities plus owner's equity. And it looks like my assets total $121,305. And looky there, it adds up to $121,305. At this point, we can say we at least have put two account transactions that balance each other out on the actual accounting equation of assets equal liabilities plus owner's equity. It does not mean that we couldn't have made a mistake somewhere. It just means that our assets still equal liabilities plus owner's equity. But at least at this point, we know we probably haven't made any large mistakes at the time. In the second part of this problem, we will use this particular part here to complete the financial statements.